This session is titled Discussion with a Director. The Honorable Dana Popish Severinghaus, Director of the Illinois Department of Insurance, sat down with Frank Paul Tomasello, Executive Director of the Institute's Griffith Insurance Education Foundation, to share her thoughts on a variety of topics. The program is a collaborative effort of the Institute's Griffith Insurance Education Foundation, the Insurance Regulator Education Foundation, and the Cady School of Insurance at Illinois State University. In keeping with the respective missions of these organizations, the program is purely instructional in nature and does not support a position on any issues.
I'm Frank Tomasello of the Institute's Griffith Foundation, and joining me in conversation to share her perspective on a variety of topics related to insurance and its regulation is the Director of the Illinois Department of Insurance, Dana Popish Severinghaus. Director, thank you for being with us.
Thanks for the invitation. It's great to be here.
To get things started, do you care to share some information about your background and also what led you to serve as the head regulator of insurance in Illinois?
Sure, thank you. So I've led the department in this role since January of 2021. Before that, I worked in the insurance industry for two major insurers, both health and P&C companies that are headquartered here in Illinois. I'm an attorney with an extensive background in government relations and also worked for the state of Illinois as senior advisor to CMS, which is the agency responsible for overseeing health insurance for the state's employees and retirees. So I have a pretty diverse background, which has been a really good fit for this role. So, when I heard there was an opening, I thought there was an opportunity to bring my skill set, a familiarity with many types of insurance, knowledge of the legislative and regulatory processes, insight on working within administration, and an ability to bring stability to the department and let its employees thrive in their roles. So when I got the call, it was a pretty easy answer to say yes to.
Thank you for sharing that. Director, insurance codes are voluminous, and of course, they vary from state to state. However, I think most provisions support common and fundamental objectives. For the benefit of the folks joining us today, how would you define those objectives? We appreciate your insight there.
Yeah, absolutely. Part of what has made solvency regulations such a success story in Illinois are the robust requirements and tools that regulators have at their disposal, such as, conservative reserve requirements continuously monitored by the NAIC's actuarial task forces, risk-based capital requirements, which are also monitored by the RBC task force, the group which is primarily made up of actuaries, requirements including an RBC plan when RBC ratio triggers are met, NAIC accreditation requirements that assure solvency laws and regulations are adopted by states and that state DOIs are staffed appropriately and meeting minimum standards in their review work. Financial exams every 5 years, review of quarterly statutory statements, and then, other tools include ORSA reviews, the work that's done by the NAIC's FOG, which is the Financial Analysis Working Group. While insurance codes are impacted by the legislative goals and perspectives of the current administration, our state is committed to promoting access to coverage using our regulatory authority to ensure a vibrant and equitable insurance market. For example, the department championed a bill this last legislative session that was signed by the governor just on May 26th, which prohibits surprise medical bills, which is when a consumer receives a bill from a provider that they didn't know was out of network. That's just one example of how we protect Illinois insurance consumers.
Yeah, very broad base of objectives and initiatives underway, as you highlighted, for regulators throughout the states. We appreciate you sharing that overview for us. Shifting gears, a lot of attention has been focused as of late on InsurTech and its potential to transform insurance and risk management and to bring benefit to insureds, insurers, and I think more broadly, really to benefit society. Director, there are many observers that suggest that this pace of change brought about by technological innovation is increasing ever more quickly. In this environment, does a focus on fundamental regulatory objectives become even more important? What's your view there?
Well, perhaps we could broach the issue of how insurtechs create innovations in process-related areas, for example, claims. They're able to gain access to substantial amounts of capital and data that standard new insurers often don't have the same access to. These entities also embrace technologies and digital alterations that legacy carriers often state they will not or cannot implement without significant impact to their current systems. Although these are welcome innovations, various departmental regulatory staff must continue to diligently monitor aspects concerning pricing, underwriting, and claims practices. To effectively monitor these concerns, department staff can institute operational reviews of insurtech companies into their analysis practice. This often involves a cross-divisional approach as it encompasses IT staff, statisticians, legal staff, market conduct, and others. Staff can use key performing indices to see how they're performing against peer companies. The cross-disciplinary approach coupled with root cause analysis can be tremendously helpful in finding out why a particular company might not be performing successfully. This proactive approach can benefit the carrier as well as the department.
Appreciate the perspective there. Given the focus of our audience on financial regulation, I'd like to delve, if I may, a little more deeply and obtain your thoughts on issues of particular importance today to those concerned with solvency regulation. To get the ball rolling, advances in modeling based upon big data and AI present some exciting opportunities for the future. Would welcome your perspective on that topic and perhaps some insight into the role of regulatory oversight in the area. And I know you touched upon a number of areas of oversight already, but we'd love to drill down a bit there if you're open to it.
Yes, of course. I think we all know that big data and AI are fueling advances in modeling. Big data analysis enables insurers to identify potential customers' preferences, design products to satisfy specific insurance needs. Artificial intelligence can help insurers eliminate underwriting expenses and improve efficiency of administration and claim systems. However, with both those benefits comes responsibility for the insurer and for us as regulators. So these analyses must be conducted without invading customers' privacy or resulting in unlawful discrimination against protected classes, for example, race and sexual orientation. To protect privacy and confidentiality, insurers should seek customers' consent, and the collected data can only be used for the stated purposes. As data is increasingly leveraged and shared, we want to ensure protections for consumers' privacy and fairness in the way that data is used in underwriting and analysis assessment of risk. Regarding protected class data specifically, people should certainly have affordable insurance in accordance with their risk profile. We know it's top of mind for advocates, particularly in terms of the unintended effects of data on various groups. And we must continue to be mindful of that as we work on this with other state DOIs, such as on the NAIC's Special Committee on Race and Insurance. The NAIC's P&C model review team is also active on this and lending its expertise with AI. Some of the member states are sending in filings to the team, which look at the company's models and assist states by looking for problems with predictive analytics.
Thank you, Director. And based upon your comments, is it fair to say that there's a significant amount of sort of collaboration or exchange amongst leaders in the various states around these issues? Is that a fair characterization?
Yeah, absolutely. Look, I think we all know we have limited bandwidth and expertise in these situations, right? And the more that we can collaborate and share what we know as the industry evolves in this way fairly quickly, I think, if we look at the evolution of the insurance industry over time, it's growing more quickly now than it ever has. And we need to be proactive in what we do, not just reactive, right? And so as we continue to learn and build resources, I think now is the time more than ever where we really need to rely on one another, our strengths and our knowledge, and collaborate moving forward.
Thank you. On the topic of insurtech, we've seen insurtech bring about the ability to offer business-to-consumer insurance models, which in many respects could mean reduced costs and perhaps greater efficiency. But without pre-underwriting, there are some observers that wonder if there may be greater risk, and if so, what might that mean from a solvency perspective? If you care to share any thoughts there.
Well, the department is aware that these type of offerings exist because there's a consumer need and a desire in the insurance marketplace. Still, as a regulator, we are always considering consumer protection and solvency. Our compliance folks, as well as our financial analysts, conduct the necessary due diligence prior to allowing these products to be purchased in Illinois. Additionally, through consumer complaints, we monitor the claims experience of these entities, just as we do all companies under our regulatory authority to ensure compliance and identify trends that may be developing.
Shifting gears a bit, from an economic perspective, we're in a period of very high inflation and low investment returns. What might that mean for insurance regulators concerned with financial regulation and solvency? And are concerns perhaps even greater on the life insurance side of the house? For the benefit of the regulators in attendance today, we'd appreciate your perspective there as the leader of the department in Illinois.
Well, with inflation reaching, I believe, 8.5% in March, the Federal Reserve Board has raised key interest rates to combat the increase. Unfortunately, for some insurers, the Fed's action resulted in an environment of high inflation and low investment return because of the investment rates for existing assets are tied to previous interest rates prior to the Fed's recent action. And so while major insurers can attempt to counter the inflationary pressure by streamlining operations, outsourcing to TPAs, et cetera, and investing in artificial intelligence, small insurers such as fraternal societies may not have such flexibility due to their small scale, legacy operating systems, and lack of cutting edge skills. Thus, expense is likely to be a significant factor which threatens the solvency of small to mid-sized companies if high inflation persists. And we will continue to monitor all companies' operating results and the impact of expenses. Low investment returns adversely affect all insurers, but it's more significant for small insurers. Major insurers with adequate capital and sufficient asset diversification can sustain credit risks and temporary market value fluctuations. Some of their options include investing in non-traditional assets, such as structured assets, to enhance the investment yield. Of course, small insurers or undercapitalized insurers may not have the same options, and the department will continue to monitor insurers' reports, financial projections, investment strategies, and their projected investment spreads to identify trends and flag outline concerns.
Thank you, Director. Appreciate the insightful response. These are indeed challenging times, but our sense is that the department, and we appreciate your opinion with respect sort of to others, but sort of our sense is that really across the country, departments are responding to these times. I think it's important that we make note of that. Would you concur that sort of the various states are
Yeah, absolutely. Absolutely. I think given the financial issues and inflation coupled with changes in environment, greater, sizable disasters and the impact, I think solvency is top of mind for all of us because we are obligated to do to, serve our constituencies and consumers. And so, I'm grateful to be Illinois positioned where we are. I'm grateful for my team and our examiners. I feel very strongly about the solvency of the companies domiciled in Illinois. And, when things are trending, we work with companies very early on to see if we can correct course and save those companies and their consumers from insolvencies. It's definitely top of mind for all of us.
Indeed. Earlier in this program series, sessions were produced around the topics of reserving and the role of guarantee funds. As director, do you care to offer any insight on those topics?
Yeah, absolutely. I've previously served on a guarantee fund. I think that the work that they do is incredibly important, and they are a real ally to consumers and regulators in the work that they do and in, their efforts to make policyholders whole. The guarantee funds play a critical role in the insurance market. Recently I spoke at the Property and Casualty Fund in Illinois' annual board meeting just last Friday, and met with the Health and Life Fund just this week to get updates on both of their sides and share what we're working on and places where we can work together. I think it's really important. I spoke to both of these groups about this, that, we maintain open lines of communication with them, work towards our mutual goal of protecting consumers together. I think we all have limited bandwidth and how much information we can gather. And sometimes, our ships crossing in the night on what's going on. So I think having, quarterly check-ins with those groups to see what's on their radar, what's on ours, some things have been happening on the federal level that I think they would care about, and, making sure we just information share and trade and work together towards the same goal. I think there's a lot of opportunities for collaboration, and they're just incredibly important in the work that we all do.
Thank you, Director. I want to shift gears a bit here and talk a little bit about what for many may be the elephant in the room, as it were. That is the subject of cyber risk. So for many folks concerned with solvency, that is indeed a concern. In your view, how significant is cyber risk and what may lie ahead kind of from a regulatory perspective?
Right. Well, we face the challenge of how to deal with growing cyber threats to insurance companies, as is the case for any industry, and what to do about that as regulators tasked with ensuring company solvency and protecting consumers. As co-vice chair of the Innovation, Cybersecurity and Technology Committee at the NAIC, I can tell you that the NAIC's Model Law 668 is aimed at addressing some of the issues to help establish standards for data security and for the investigation and notification requirements. That's something that we're working on with the General Assembly here in Illinois and interested stakeholders. We were not successful in getting that done last session, and I think, it's top of mind as these concerns continue to grow for regulators and the industry alike, and yet another area we can collaborate and get something good in place that's going to protect consumers and help companies and help us as regulators to be on top of that issue.
Thank you, Director. We've covered a variety of topics here during our conversation. I'm going to step back a pace or two and ask if you had to identify perhaps the two most pressing items faced by financial regulators of insurance today, what would they be and why?
Only two, Frank, such a short list. Here in Illinois, we've made significant progress in filling positions, but hiring remains a huge challenge, as it has for many other industries and for, regulators across the country. From discussions at the NAIC, we know that other state DOIs are facing these issues, retirements, internal promotions, and that leaves, new vacancies and other factors. So, here at the DOI, we are increasing online recruitment and outreach. We're working to target potential talent at recruiting events to align with college graduation schedules. We're also planning more outreach to colleges with financial analysis, accounting, and insurance programs that are likely to have qualified candidates for our entry-level positions. For example, the Katie School of Insurance and Risk Management graduates, we appreciate partnering with you. And I think, insurance is just such a valuable and meaningful profession to work in. And I think, it just takes a village to get the word out that there are just really fantastic careers and a really positive impact that you can have. So we appreciate the work that you are doing in this space as well. And then the second pressing issue facing insurance regulators, and I touched on it earlier, would be climate change issues. The NAIC has set up disclosure surveys, which is optional for states. Currently, companies representing 80% of the market share are participating. Illinois is contemplating joining this initiative as well. We're having discussions with stakeholders right now to determine the impact. We're also beginning discussions with other financial regulators in Illinois to educate each other and leverage our knowledge and experience. At the NAC level, the Property and Casualty RBC group has added a catastrophe risk to the risk-based capital formula, currently addressing earthquakes and hurricanes. We are also looking at expanding this to other types of catastrophes like flood, wildfires, and convective storms. And we want to be sure that companies have a handle on their exposure relative to the changing climate in the areas of pricing, underwriting, investment, and reinsurance strategies. Climate risks exist in property, both commercial and personal, auto, physical damage, and business continuity lines. Additionally, it's emerging in other lines like E&O and D&O. More and more of these issues will be pursued during the examination and financial analysis of a company when we look at ORSAs and attend supervisory colleges. We want to be certain that a company is using reinsurance appropriately to mitigate climate risk concentrations, geographically as well as by industry and product line. We want to be certain that the company's staff have expertise in this area. And from a solvency perspective, we want to be certain that companies are aware of the exposure they are writing. Are they adequately pricing and underwriting risk? Are they also mitigating the risk by monitoring geographic and industry concentration, looking at policy limits and product concentration? These are all questions that we are asking.
Thank you very much, Director. I want to follow up with you on the topic of talent acquisition. You spoke of that as one of the two priorities that you highlighted. Do you care to share what your department's efforts regarding diversity, equity, and inclusion might look like through that lens of talent acquisition?
Absolutely. DEI is an initiative that the governor and our administration took on early on, and I think it's something that's been obviously top of mind for the NAIC for the past several years, right? And so, in asking of the industry, what are you doing? We obviously also turn internally to say, what are we doing? So early on, we formed a DEI task force, representative of our geographic locations and individuals throughout the state, and put together a plan of what are things we can implement, what are short-term things we can do, what are long-term things we can do. Most recently, we are hiring a DE&I consultant. I think that the work is just so great, and there's so many ways to have meaningful impact in what we're doing at the department that it's enough to be an individual role. So we're bringing in a consultant that we're really excited that can spearhead those efforts. As I mentioned, we're understaffed and we're looking to hire up, and I think having the ability to have one person focus on spearheading those efforts is going to be really meaningful and helpful in implementing change in the department. As it relates to hiring, we're always looking to diversify our staff. Since I took over in this role, we have brought on our first African-American woman in a leadership role in the leadership team, and our first Asian-American woman in a role in the leadership team. And I think they bring great diversity and perspective, to the discussions that we have every day. We've been trying to bring in Spanish-speaking positions to our department for years. We face challenges because existing statute requires that we bring people on in Springfield first. And so we were unable to hire downstate for Spanish-speaking positions. But after several years of work, we're able to bring on several Spanish-speaking individuals that are analysts and helping in Chicago, which is just fantastic for the constituencies that we serve, being able to have those folks in the office. And we just continue to look to diversify our efforts in that space and bring on folks that can help and reflect the constituencies that we serve.
Thank you, Director. Appreciate the insight there. We've talked about a variety of opportunities and challenges that are faced from a regulatory perspective during our conversation. From your perspective, how important is education and ongoing learning for those serving as insurance regulators? Insight from you there, I think, would be appreciated, certainly by those attending this program who are functioning in regulatory departments.
Well, I think it's absolutely critical to innovation and growth within the industry. With so many major insurers domiciled here, with the evolution of the industry as quickly as it is, it's important to our mission as a regulator to maintain our leadership role amongst other states as we work to ensure market stability and drive change when necessary and regulate appropriately. The department is quite active and vocal in NAIC activities, including membership task forces, work groups, and committees. Despite having full schedules, our folks accept as many opportunities as possible to share our expertise and contribute in valuable ways, like today, for example. This type of collaboration with the Institute's Griffith Foundation, the Insurance Regulator Education Foundation, and the Katie School of Insurance and Risk Management is extremely important. You're at the forefront with us, looking ahead to what's next, and you're just as invested in maintaining a robust industry while educating our next generation of insurers and regulators. The department, myself included, really appreciate the work that you're doing.
Thank you very much, Director. I want to ask you a final question. We will allot some time to live question and answer as attendees of our webinar know. But any parting observations during this pre-recorded video conversation that you wish to share with our audience of insurance regulators?
Oh, absolutely. Always parting words. Yes. So, as the fifth largest state and fourth largest when it comes to writing premium, the overall state of the insurance market in Illinois remains very strong. We see insurers working hard to boost efficiencies, cultivate talent, and strategically using data and technology. Despite some of the challenges that we've discussed, we're working hard to retain and attract even more insurance companies to Illinois. And I believe we're prepared for whatever lies ahead and look forward to working with you towards that goal. So thanks again, Frank, for taking the time today. I really enjoyed our discussion.
The Institute's Griffith Insurance Education Foundation, the Insurance Regulator Education Foundation, and the Katie School of Insurance at Illinois State University were pleased to collaborate on this session. We thank Director Dana Popish Severinghaus for being with us. To learn more about Griffith Foundation program offerings, please visit www.griffithfoundation.org.